talking about positive signals, Dave Floyd, founder of Aspen Trading, is joining us on the show today. He's one of the top currency traders globally, and he says that he doesn't see any signs of a recession, so we're going to find out more from him today. Dave, thanks so much for joining us. What's your view on the dollar index currently, especially given the Fed's impending rate cut and the inverted yield curve?
The dollar index, since the beginning of the year has been rather choppy. It is within an uptrend, and I expect that trend to continue. Right now, it's just a lot of back and forth price action. With the change in central bank policy here in the U.S. last week, that's obviously caught a lot of traders off guard. Hasn't done much to the dollar index, but oddly enough, I still suspect that the dollar index will move higher because you remember, in the game of the currency market, it's always who is the least ugly relative to another currency. And right now, the dollar is the least ugly currency in the major markets. So I'd be looking for the dollar index to move higher in the weeks and certainly into the end of the year. My favored way to play that is probably, obviously through dollar Canada is one way to look at it. Naturally, the euro is good. It would be good to the short side, but the euro at present time is also a bit choppy. But I would think that the euro would be lower by the end of the year and dollar Canada would be higher.
So what's the broader trend then that you're tracking, Dave, when it comes to the S&P? Do you expect it to move higher from these levels?
I could easily see the S&Ps maybe over the next week or two head down towards 2760. 2,700. We're at 2,800 right now. So I wouldn't be a buyer if you are not positioned in the S&Ps right now. I would buy a pullback in here. Overall, I remain bullish on the S&Ps, and I would say cautiously. I'm not a raging bull, but the fact of the matter remains the Fed is now even more accommodative based on what they said last week at the policy meeting. And we have other central banks lowering rates. Bank of New Zealand did that last night. The ECB is also indicating its softer policies. These are all, historically speaking, bullish to equities. I'm not saying that the policies themselves aren't flawed, but the fact of the matter is easier monetary policy keeps a bid in stock. So I would be bullish on the S&Ps on a pullback. I wouldn't be overly bearish on the S&Ps in here at all.
Right. Dave, morning. So, some analysts are saying that the positive signals are overdone and we're headed for an implosion. What do you think of some of these wildly negative calls?
Well, I can understand why there's a lot of wildly negative reports. I mean, this market for the last 5 to 10 years, many times has defied logic. We've had a very, very long economic expansion, in fact, the longest in history. And it just continues on and on. I mean, and that's a great thing. But, for someone who's been in the markets for many, many years, I've been in the markets for 20 plus years, this is very unusual. And it sometimes can be hard to get your head around. But the fact of the matter is the Fed is the #1 game in town right now, unlike any other time in history. So as long as you have a Fed that's very accommodating and willing to keep policy rates low as a way to prevent any, financial catastrophes, that is going to keep an underlying bid in the S&P. So yeah, I get that some people may look at this and say, this is going to end badly. And, maybe it will. I mean, we're in uncharted waters here in terms of monetary policy. But for right now, every time I see a dip, everybody's buying it. And it just seems as though the trend overall remains up. I'm not agreeing with the policy. I understand the logic. But again, trying to pick a top in here has been a sucker's bet for many, many years. And as of right now, while the economy is starting to slow down domestically and on a global basis, it's not at levels that would indicate a recession anytime soon. And I know we're going to start talking about the inversion in the yield curve. And I think even that, too, has been a little bit overblown. I think there's some valid reasons why we've seen an inversion in the yield curve. And it may not be indicative of a forthcoming recession, which, of course, would then not mean that the S&Ps are due to move significantly lower anytime soon.
Okay. What about the yield curve then? And do you think an inversion which is now beginning to take place in the US 10-year paper, because of which, there are these fresh recession concerns, you don't see it following past patterns, predicting a recession?
Well, yes and no. I mean, again, we are in a very different phase from an economic perspective than we have at any other time. So you have to factor that in. The Fed is a major player in this now, whereas they weren't as much, say, 20, 30, 40 years ago. I'm not saying that the inversion in the 3-month 10-year is not valid. I mean, it's minor. It's about 5 to 10 basis points at present time. But the rest of the curve is not inverted. In fact, if you look at the 5 and the 30 spread, it's actually rather steep at about 67 basis points. And then if you also look at, I'm just going to look at my notes here real quick. If you look at the 210 spread, that's at about 15 basis points in terms of the steepness. It's not inverted. So historically speaking, when we've had a recession, you've had about 75% of the curve inverted. That's not the case right now. And I'd add one other thing that in talking with colleagues over the last few days that could really give a real good indication as to why we do see the inversion right now on the 3-month 10-year curve. And that's because last week's announcement by Jerome Powell really caught a lot of people off guard. It wasn't more than a month, 2 months ago that he was saying we are a long ways from normalizing or getting to that neutral Fed funds rate. And then last week, all of a sudden, he's like, no more rate hikes for the rest of the year. That was not at all what the market was expecting. But the reason, or I should say, one likely reason why we saw yields drop so low and that 3-month 10-year spread invert is that we probably saw a flight to a lot of hedging in the interest rate swaps market. Again, think about it. You're a mortgage trader, or you're just a bond manager with a lot of exposure, and you get blindsided with that. You're not factoring that in. You're trying to hedge your existing positions, and that's just going to add fuel to the fire to drive rates lower. So again, I'm just looking for maybe some counter arguments, because everybody now seems to be looking at the curve and going, we have an inversion, we're going to have a recession. Maybe, but I'm just looking at it a few steps beyond that and trying to be a little bit more objective and a little bit more historically, rooted, so to speak. And as of right now, I'm paying attention to the inversion, but I'm looking at other parts of the curve, and I'm not seeing an inversion.
Dave, wanted to get in your view on emerging markets then, even if you don't track them very closely. If you had to take a call, would it be fairly positive on emerging markets, and specifically for India right now? Are you positive?
Well, again, emerging markets, the direct impact, the direct correlation to a firmer emerging markets is going to be a weaker US dollar. And as I said at the beginning of the interview, I'm not looking for a weaker US dollar by year end. So by default, that's going to add pressure to the emerging markets. I happen to look at the ETF EEM. That's a good barometer for how emerging markets are performing. And yes, it's rallied this year and it's done okay, but overall it still is in kind of a downtrend. I would say if we see EEM fall below $41.80, that would be indicative that the trend is resuming to the downside. And of course, the dollar index would be moving higher. So for me, it's really hard to be bullish on emerging markets, given my forecast on the dollar index. Now, if the dollar index starts to tank for whatever reason, then of course, emerging markets are back into a bullish mode, or at least, modestly bullish mode. But I personally would not be long emerging markets in here until we get some sort of an indication that the dollar wants to move lower, and I just don't see that, at least in 2019.